Hi everyone and welcome to this week's macro briefing. Here at Bitsilk Investments, we break down the market bit by bit to give you a silky smooth understanding. Before we get started, let me just mention that all prices and forecasts correspond to the date of this publishing, and this information is strictly for training and educational purposes only. So starting with the news update, we've talked about lockdown winners and losers before, and how COVID is a winner-takes-all scenario. And in terms of big businesses versus small businesses, it's big business that's been the winner. And you can see that with Tesco announcing they're going to add 16,000 more jobs. And most of these are related to their exceptional growth in their online business. So with 10,000 jobs allocated to picking orders and 3,000 allocated to delivery drivers. So if you're looking for a job and you're struggling a bit, I recommend applying for Tesco. They're in a great position right now, and that's because they're highly leveraged to the new online economy, but they also have their traditional brick and mortar infrastructure. And talking about small business versus big business, I've recently just noticed that one of the local corner shops in my area has closed shop now. So the absence of these small businesses is going to leave gaps for the big ones like big companies like Tesco to fill in the future with their stores like Tesco Express. So moving on, home builder stocks have rallied massively in the US, and that could be because of this narrative of people wanting to move out of the big cities as they're a little bit scared about coronavirus. And this means people want to build new homes in more rural areas. And in relation to this, timber prices have gone through the roof, and all of this is good news for the economy, as home builders stimulate a lot of demand for many services. Next, there's the narrative of biotech overtaking traditional medical companies. So Pfizer, which is a very old company and one of the world's largest pharmaceutical companies, that's been removed from the Dow Jones Index and has been replaced by one of the world's largest biotech companies, Amgen. Okay, so stocks have made new all-time highs this week, and let's take a quick look at the charts now. Okay, so we have a chart over here of the S&P 500, and somehow the gravy train has kept on going, and it's blasted through this level that we warned about a few macro briefings ago, where we might see a potential correction. And the reason is just the pure amount of liquidity in the system right now. And the current economic situation is the perfect scenario for more of this stimulus to come, because when the economy is slow like it is today, that's when central banks have reason to provide the most liquidity to get economy flowing. When the economy gets too hot or things are looking more normalized, that's when the liquidity will start to get pulled back. And that's when you might see a liquidity-driven market like this one start to have some real issues. But in this sort of interim period between a slow-moving economy and a fast, full-flowing one, that's great for liquidity, and that's also great for stocks. Which means there's nothing to say that these pre-existing extremely high valuation distortions can't persist a while longer, at least until we see the next foreseeable downside catalyst, which is the US November election. And this is especially considering that the Fed has just added another 3 trillion to its balance sheet, bringing it from 4 trillion to now 7 trillion US dollars. So within stocks, let's take a look at which sectors are doing the best. Year to date, there's been a big bifurcation between tech and consumer cyclical, and financials and energy, with tech and consumer cyclical having massive outperformance. However, on a 1-month basis, most sectors have benefited from the recent broad bullish sentiment, and I'll just go through some notable performances by sector I've seen. So one is Nike being up 14.71% in consumer cyclical. Apple just over 31% now in tech. Facebook's up over 20% in communication services. And I've recently heard that Zuck has been firing shots at TikTok recently. And it looks like investors are liking the beef, with Facebook continuing to rise. UPS has posted massive gains, a 31% gain in industrials. For real estate, PSA, which is a holder of industrial properties, rose 11%. PayPal rocketed up 13% in financials, and Target posted the biggest gains in consumer defensive with 24%. For healthcare, Merck & Co appreciated 8.5%. For utilities, AES Corporation had 17% of gains. In basic materials, Ecolab was down 7%. And finally, in energy, Exxon is down 7.2%. So moving on to gold, we've been covering gold quite a bit on this channel, and for gold, although we've had some recent corrections, we believe the bull case for gold is still intact. So we've gone through the entire bull case for gold on our video, The Perfect Storm for Gold. So I recommend you watch that on our YouTube channel if you haven't seen that already. But we can just attribute the recent corrections to gold in part to the recent pickup in yields, and rates are increasing. People are selling bonds, possibly because investors are worried about some of this potential inflation issues from these rising commodity prices. And in turn, that might have dropped gold recently, but in the long term, in the medium term, we're still very bullish for gold. Okay, so for Forex, the past 3-month trends have been pretty simple. Basically, everything's bullish apart from the US dollar and the yen. And it's been a very long, sustained rally in the past 3 months in currencies like the Aussie dollar. So let's take a quick look at the charts now. Okay, so on the screen here, we have the weighted average of the Aussie dollar, and you can see it's been a very long 3-month rally. And the only problem is we can see that we're losing a bit of momentum here now. However, I do think there's still enough juice in this market to make it back to the all-time highs before we have a significant correction. And that's the same case for a lot of these. In the short term, I think most of these broad trends on that slide over here are all going to go up, all going to continue, as long as we have the equity markets holding up. When we see the equity markets crash, that's when you're going to see a big reversal with the US dollar and yen going higher, changing direction. However, right now things are generally intact, so we don't see that happening yet. And I'm just going to go through a little bit of detail of into why the Aussie dollar has appreciated recently. So I have a few positions on this one myself, so I've done a bit more research onto it. I'm currently betting on the Aussie dollar to go up relative to the euro, and also the New Zealand dollar to appreciate relative to the euro. And that's simply because they've both been massive outperformers, and that's partly due to the massive rise in commodities we've had recently. But I'll explain a few more factors going into that now. So for the Aussie dollar, they had a record high trade balance, and that's been supported by these commodity prices. So the massive rise in gold prices and iron ore prices have really benefited their trade balance. Next up is another factor, which is the 10-year bond yield differential between Australia and the US. So that's actually turned positive and broken out of this long-term downtrend you can see over here. So this grey line has rocketed up above 0% now. So why is this a bullish indicator for the Aussie dollar? That's simply because if the Aussie dollar is returning a high yield than the US dollar, then that's going to give incentive, it's going to increase demand for the Aussie dollar by investors. And the reason why this is suddenly a complete reversal to the upside is because of the Fed's aggressive monetary easing. So because of that, this spread is now reversed. And here we have the FXA in the blue, which that's simply an ETF that tracks the Aussie dollar's movement. And you can see there's a really tight-knit correlation here. So if we expect some mean reversion to happen, then we can expect that this blue line to revert and catch up with the grey line here, suggesting more upside for the Aussie dollar. Finally, the Aussie dollar is likely to continue to strengthen as long as we have this continuing equity market bull market, and that's because the Aussie dollar is a risk-on currency, so it's highly correlated to stocks. Okay, so to wrap up today's presentation, The risk on narrative from central bank liquidity is still in play. The next major downside catalyst is the US November election. This means continuing trends for most asset classes that have been going on for the past 3 months. And we've also seen more and more commodities that are rallying. So recently timber and corn, and even oil has picked up again and is shooting back up to the upside. And finally, watch out for the US non-farm payrolls next week. So that's the most significant market data apart from the Fed minutes. And for the last 4 months, non-farm payrolls have beaten analyst expectations every single time. So let's see what happens next week. And with that, thank you for watching and have a great day.